Hey everyone, welcome back to Corporate Dakota, the place where we crack open these financial reports and try to figure out if this company is rolling in dough or going down the drain. Get ready because Fox Corporation's latest earnings report is here and we're diving in. Alright, so Fox Corporation just dropped their quarterly report, the 10Q for the period ending the 31st of December 2025. Think of this as a mid-season report card for the company. We are going to skip all the boring legal mumbo-jumbo and get straight to what really matters: the money, the performance, and what it all means for you. Remember to hit that subscribe button and join our Discord community linked in the description below to keep the conversation going. First up, let's look at how much money is actually coming in and going out. For the 3 months ending the 31st of December last year, their revenues were $5.182 billion. That is a bit higher than the same time the year before, which was $5.078 billion. So a small increase there, about 2%. Now let's look at the 6-month period ending the 31st of December. Their revenues were $8.920 billion compared to $8.642 billion the previous year. That is about a 3% jump. On the surface, things look okay, revenues are growing, but we need to dig deeper. What about the cost of doing business? Operating expenses for the 3-month period went up to $3.895 billion from $3.776 billion. That's a 3% increase. For the 6-month period, operating expenses increased by $185 million to $5.979 billion. This means that while revenues are growing, so are the costs to generate them. It is like trying to fill a bucket with more holes in it. Selling, general, and administrative expenses also saw a notable jump. For the 3 months, they went up by 13% to $595 million. Over the 6-month period, they increased by a significant 15% to $1.184 billion. This increase is being blamed on marketing for a new streaming service called Fox One and higher employee costs. That launch seems to be costing them. When we put all of this together, we see that income before income tax expense took a bit of a hit. For the 3 months, it dropped by 37% to $322 million. And for the 6-month period, it fell by 31% to $1.121 billion. All those rising costs are starting to eat into the profits. And ultimately, for the shareholders, the net income attributable to Fox Corporation stockholders tells the real story. For the 3 months ending the 31st of December, it dropped by a hefty 39% to $229 million compared to the prior year. And for the 6-month period, it was down 31% to $828 million. This is a significant decrease, and it's a direct consequence of those rising expenses and that non-operating other net category, which we will get to in a moment. Now let's talk about this tricky non-operating other net item. For the 3 months ending the 31st of December, it was a negative $161 million. The year before, it was a positive $81 million. That is a big swing of $242 million worse. For the 6-month period, it was an even bigger negative $286 million compared to a positive $314 million the prior year. That's a $600 million swing for the worse. This is a huge factor in the profit drop, and it's mostly tied to investments, including their investment in Flutter Entertainment changing in value. Basically, the stock market or their investments took a big dive, impacting their bottom line. Let's see how the different parts of their business are doing. Cable network programming saw its segment EBITDA, which is a measure of profitability, increase by 5% to $687 million for the 3-month period. For the 6 months, it was up 6% to $1.487 billion. That part of the business is performing quite well. However, the television segment saw its segment EBITDA drop by 30% to $143 million for the 3 months, and by 6% to $542 million for the 6-month period. This segment is clearly struggling more. The increase in revenues was not enough to offset higher operating costs and a decrease in content and other revenues. And then there is the corporate and other segment, which includes their new streaming service Fox One. This segment is currently losing money. For the 3 months, its segment EBITDA was negative $138 million, a significant worsening from the prior year. For the 6-month period, it was negative $272 million. This is where those launch costs for Fox One are hitting hard. Now, Fox also presents something called adjusted EBITDA. This is meant to give a clearer picture of the ongoing business performance by excluding certain items. For the 3 months, their adjusted EBITDA decreased by 11% to $692 million. For the 6-month period, it was down 4% to $1.757 billion. This shows that while the core business might be slower, the adjusted numbers still reflect that pressure. Let's talk cash. For the 6 months ending the 31st of December last year, the company used $799 million in cash from operating activities. That is a lot more than the $204 million they used the year before. This increase is mainly due to lower political advertising receipts with no elections happening and higher sports programming payments. It means more cash is flowing out than before. And what are they doing with their cash? They spent a massive $1.8 billion on repurchasing their own shares in the last 6 months. This includes a significant accelerated share repurchase program. They are buying back their stock aggressively, which can be a sign of confidence or an attempt to boost share price. There was a significant update to their corporate structure with a new stockholders agreement signed on the 8th of September 2025. This agreement involves LGC Holdco and some Murdoch family trusts. It sets limits on voting power of the Class B stock and basically keeps control within certain family factions. This is important for understanding who ultimately calls the shots at Fox. Looking at the less glamorous side, legal matters are always a factor. Under restructuring, impairment, and other corporate matters, they had $14 million in charges for the 3 months and only $6 million for the 6 months. This is a big improvement from the prior year when they had $170 million and $196 million respectively. This indicates they have resolved or are no longer facing as many costly legal battles, or the impact of initiatives like the discontinuation of venue sports. However, the report also mentions ongoing defamation and disparagement lawsuits, including the one filed by Smartmatic USA Corp, seeking $2.7 billion. While Fox believes these are without merit and intends to defend them vigorously, the potential outcome remains a significant risk. They are unable to predict the final outcome, and there is a chance it could materially impact the company. There is also a derivative lawsuit filed by stockholders against directors and officers. This is important for corporate governance and accountability. Now for the warnings, the report reiterates the usual risks like evolving technologies, declining subscriber numbers, and intense competition. But a key point is the ongoing challenges in advertising expenditures and the potential impact of piracy and signal theft. They are also concerned about unfavorable litigation outcomes and regulatory changes. So what is the big picture here? Fox Corporation's revenue is inching up, but their costs are rising faster. The core businesses, especially cable programming, are holding steady, but the television segment is facing pressure. The big story is the significant increase in expenses related to new initiatives like Fox One and a big hit from their investments which severely impacted net income. They are also spending a huge amount of money buying back their own stock. The legal risks, especially the Smartmatic lawsuit, remain a significant unknown. Overall, Fox is navigating a tough media landscape. They are growing revenues, but the profit margins are shrinking due to higher costs and volatile investment performance. Their direction seems to be a pivot towards new digital ventures, which is costing them dearly in the short term. The big question is whether these investments will pay off or if they are just burning through cash. The legal battles add another layer of uncertainty. What do you think about Fox Corporation's latest financial report? Are they smart to invest in new ventures, or is it too risky given the current pressures? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community linked in the description for more great discussions. Thanks for watching. See you next time.